After the speaker presentation,
perhaps even the bravery shown by the entire Peyto team. On to our first quarter results. Obviously, the first quarter proved to be a very challenging period for Peyto with a very sudden and dramatic drop in oil prices during the quarter, and we had a pretty consistent erosion even in natural gas prices throughout that quarter. So not only did we have to deal with the pandemic and all of the things that brought, we had to deal with some rather terrible commodity prices too. This was quite the reversal from the fourth quarter sentiment, where we were very optimistic on where gas prices were going, and the fact that we expected 2020 to be a bigger and better year than 2019. But I suppose so far that's not been the case. However, our team here at Peyto remained very nimble, and we responded to these new challenges as we always have, with straight head on. As we saw, the winter heating season failed to materialize, and the gas prices, particularly the NYMEX price in the U.S., which we're now much more exposed to, we saw that NYMEX price basically erode away in the quarter. We decided we needed to slow down our winter program a little bit and defer some of the capital that we had planned in the earlier part of the year to later in the year when we could see prices tighten up a little bit. We did that, I think, in February by dropping some drilling rigs. Then in March, of course, the oil price crashed on the demand impact due to COVID-19, and we had the price war between Russia and Saudi Arabia, where they were threatening to flood the market with a whole bunch of production. So a lot of changes. We had to completely reassess our drilling plans for the year in light of the impact to our economics that those commodity prices brought. So we quickly shifted our focus away from the more liquids-rich Cardium opportunities we've been chasing all of 2019 to now the more leaner, drier gas Spirit River opportunities that we have within our portfolio. I think, it's a real testament to Peyto and its nimbleness to be able to do that so quickly and so efficiently. By the end of the quarter, we'd revised our capital plans for the year. We rebuilt our entire drilling schedule with more of a focus on leaner gas opportunities. Also, by the end of March, we saw a new commodity strip evolving with some real interesting developments on the oil supply side, as now we had potential shut-ins being promoted. Storage was filling rapidly. The OPEC plus group was talking about taking a lot of volumes offline as opposed to flooding the market, and there was an interesting sort of follow-on effect with respect to associated gas being shut in and therefore causing gas prices to rise. And that last effect really was the silver lining for us as a gas producer, and we started to focus on that one. However, we had to be a little bit careful because we also produce condensate, and we had to think about what would happen to that condensate as heavy oil in Alberta was shut in. So there were a lot of sort of exterior market considerations to think about in the first quarter that kept us on our toes. Those are all the things going on outside of Peyto that we don't really control. Inside of Peyto, though, I think the things that we do control were going quite well. We drilled some very nice wells in the first quarter, finished up a large 3D seismic program over a big block in the southern area of Greater Sundance. We built a large diameter pipeline that opens up a brand new area in South Brazeau called Chambers. We continue to see improvements in our capital costs, and Lee is here this morning. Hopefully he can talk a little bit more about how those might continue to evolve this year. Operating costs in the quarter were a little higher than normal, mostly due to our preparations really for COVID-19 supply chain disruptions and a few other things, but we've got some great initiatives for the rest of the year, which should see those coming down. Todd can talk about those a little more. From a production perspective, things ran pretty smoothly. As both propane and gas prices changing throughout the quarter, we were inclined to toggle our deep cut on and off, depending on whether propane prices were too weak and gas prices were strong, or then gas prices weakened and propane prices got stronger. We seem to be getting better and better at this, though, so it's nice that we have that flexibility to target the best price possible and put the production in the right form to attract that best price. As I mentioned, we were concerned with how our condensate would be priced and handled. If a lot of that heavy oil demand disappeared, then so too would the demand for condensate. So We collected all of our tanks. We rented a bunch more tanks, and we built a couple of key tank farms on a couple of plant sites to store about 80,000 barrels of condensate, which is 2 to 3 weeks worth of production, just in case there was a major disruption to the condensate markets. This is likely more of an insurance policy than anything, so we don't have to shut in all of our production, gas, condensate, and NGLs, if there's a problem with getting our condensate to market. It was fairly inexpensive to build this capacity and this insurance, so I think it's the right move. And we don't know yet whether we're going to use the full capacity or not. We're definitely not through the oil storage problem yet. It is still continuing to mount out there, so it's a good bit of insurance to have in our pocket. Financially for the quarter, commodity prices were some of the lowest we've ever seen at Peyto, unfortunately, and delivered the lowest per unit revenue in our entire 21-year history. So even with our low costs, that translated into the lowest netback in our history as well. These low prices caused the independent reservoir engineering firms to drop their price deck substantially, and that caused a significant impact to the perceived value of our reserve assets. When we compare that to what we spent on those reserves, we ended up having to record a small non-cash impairment of around $80 million, and that in turn results in a loss for the quarter. This is the first impairment we've ever taken as a company, and it's the first quarterly loss we've posted in the last 15 years. It wasn't really a record I wanted to break, unfortunately, but it is a sign of the times. We'd expect that as oil and gas prices rise and the reservoir engineering firms increase their price forecast back up, that this impairment will reverse. So unfortunately, the extreme volatility in commodity prices translated into fairly extreme volatility in our earnings. So that was basically it for the quarter. It was a bit of a tough quarter, but we managed to make it through intact, and I think we're looking forward to some improvement for the rest of the year. Joelle, perhaps we could throw the line open and just take some questions from those listening in.
Thank you. As a reminder, to ask a question, you'll need to press *1 on your telephone. To withdraw your question, press the # key. Please stand by while we compile the Q&A roster. Our first question comes from Fei Li with Odlum Brown. Your line is now open.
Hi, it's Fei here. Darren, I just want to talk a little about the impairment test that was performed, and does it reflect the hedging, your hedges in place and the diversification arrangements?
Yes, it does. Those arrangements were included in the reserve evaluation. So depending on what the commodity prices at those various hubs are that are forecast by their independent reservoir engineers, then that translates into what our realized prices would be. Obviously, our reserve report is somewhat tailored a little bit to the commodity prices that we perceive at the time. When we did it at the year end, we had a lot of cardium drilling at the front end because gas prices were weaker and oil prices were stronger, and so naturally that's the way that we built a drilling forecast going out, picking from the inventory that we have. We don't populate the entire reserve report with all the inventory that we have in the future, obviously. We have a couple thousand or more locations, obviously, to choose from, and the independent reservoir engineering firm will pick from those for the next 5 or so years to populate a forecast of development. It only takes a fraction of our undeveloped locations then and puts it in the reserve report. But we try to direct them a little bit as to what's the most profitable looking species that we're drilling from, and so for the last year or two it's been the cardium with its high liquid yields, and so we brought those to the forefront and put those first up. I think realistically though, if we were to rebuild the complete reserve report today reflective of the dramatic change in the commodity price, we would bring a lot more of our drier gas opportunities forward earlier in the forecast for development. So there's little sort of changes within the the way the reserve reports are constructed that don't adapt to such a dramatic change in commodity prices, obviously. But the reserve report is relatively fulsome in that it reflects all the parts of our business.
Okay, so that's kind of where my follow-up was going to go. It's like it looks like one of the criticisms of the reserve engineers is that the price assumptions or evaluation companies, the price assumptions they use have always seemed to be quite aggressive relative to where the forward or strips are or where current prices are. And certainly the debt looks, what you've outlined in your MDA looks a lot more realistic. So in terms of valuing your book value, which is close to, I guess, $10 per share, is that kind of, it seems like, am I interpreting correctly when it looks like it's more representative of the NPV based on this current price deck that's outlined in your MD&A? Is that the way to think about it? Plus, obviously, there's some stuff that you mentioned that are not included in that report.
Yeah, although, still, it's very difficult, obviously, for the independent reservoir engineering firms to come up with a forecast as well right now. There's been so much change going on that you're right. We criticize them maybe a little bit that their forecasts are optimistic relative to strips sometimes when we look at it. But you have to remember that these are the same guys that do look at everybody's F&D costs. They do look at everyone's supply costs. So when they're looking forward and forecasting what commodities they think commodity prices are going to be, yeah, of course they, I'm sure, incorporate what the strip is going to look like. But they also know what the industry's supply cost is. And so they, in some ways, they know what the commodity price has to be in order for people to have economic drilling prospects and in order for the industry to move forward, replacing its depletion. And so, in a way, we have to kind of believe what they believe in somewhat, because they do know what the industry's cost structure is like. You know what I mean? So in some ways, we can criticize them for their belief in the commodity price being different than the strip, but the reality is, the strip sometimes isn't all that right either, and maybe the strip isn't as knowledgeable as the independent engineering firms are of what people's actual costs have been to convert new reserves into production. You know what I mean? So, we like to beat on those guys because, they make a forecast of commodity prices, and everybody who makes a forecast of commodity prices is generally wrong. Nobody really knows what the forecast is going to be. But these guys go out on a limb and they do, in their defense, they do see what everybody's conversion costs are, and from that, I'm sure, they determine what the commodity price needs to be. And so maybe, when we look at the independent engineering firms and we see a forecast that's higher than the strip today, what we really should conclude from that is that the supply cost is actually higher than the strip today. And so, one would expect that activity levels would probably drop off if those strip prices continue to persist, and they have to get above what the company's supply costs really are to be manageable.
Okay.
So, sorry, that doesn't really answer your question. I mean, it's a little bit more background, perhaps information on those independent engineering firms, but all of this stuff is changing quite rapidly, and next quarter we're probably going to see a significantly different forecast from those guys, and that's going to flow through to a significantly different impact on our reserve values, and one would expect, and I think most people do expect in the industry, that as commodity prices turn around, that a lot of the impairments, obviously, that the industry has had to take this quarter are going to be reversed.
Okay. But the book value of your assets now, it seems like with impairment and the changes, it seems to match you're marking to market almost a bit to the assumptions laid out by the reserve evaluators. Is that kind of the way to think about it?
I don't know. Is that how you would look at it, Kath? I don't think from a book value perspective.
I'm not really clear on.
Sorry, Phi, I'm not sure what you're getting at, but...
Yeah.
Okay, maybe I'll follow up offline with you on that.
Okay.
Thanks.
One thing to just add, Darren, which you covered that well, the reserve companies have begun to calibrate the near-term prices a lot closer to the strip. But the strip at the end of the year is just, it would be erroneous to just plug in a current momentary strip at the end of the year. It can vary quite a bit over the course of the year depending on the season. So I think these, the reserve engineers, as you stated, are trying to look at the big picture and the true supply-demand on the out years while calibrating the in years or the near years closer to that strip.
Okay. Thanks. That's all for me for now. Thanks.
Okay, thanks, Phi.
Thank you. Our next question comes from Doug Younghusband with CIBC World Markets. Your line is now open.
Yeah, thank you for taking my call. Lots of moving parts. Not always fun, but it's never boring, right?
You say so, Doug.
You mentioned higher costs in the quarter due to COVID preparation. So I'm presuming those are expense costs, but over time they'll average out in future quarters, I'm hoping. Or were they sort of one-off additional costs?
No, that's right. I would say winter season operating costs generally tend to be higher. We have to obviously use more methanol to keep wells from freezing off. We've got a lot of snow removal that we're looking at. Road maintenance tends to be higher than in the summer. Todd, do you want to jump in there? What else do we...
Yeah, I got those points down for sure. Typically in the winter as well, methanol prices typically go up because supply or demand goes up in Alberta. So Q1 is typically higher, and then this year, we weren't too sure what the supply chain might do, so we did purchase a few things, lubricating oils, that sort of stuff, just in the off chance that there was a disruption and we would be able to make it through a couple of months. So, it accounted for some, but not a lot, and it will average out into Q2. That stuff's we didn't use anymore. It's just kind of sitting in inventory, if you want to look at it that way.
Sure.
If we had been able to foresee that the oil price was going to drop so dramatically, we could have waited and bought our lube oil when it was way cheaper. But I don't think too many people saw that one coming.
I don't think so.
Also, we are anticipating lubricating oils to go down, but it's not a one-to-one correlation with oil price. Obviously, it's tied to the U.S. producer price index, which did go down. It actually went up in January, and then it's come down. But as well, it's tied to the Canadian dollar. So
sure. No, I appreciate that, guys. I just was wondering if it was more of a pulling forward some expenses that you will regain sort of in future quarters or give back in future quarters. Something that's more curious to me is what's going on with world LNG natural gas prices, and will that ultimately translate backwards into North American prices? I mean, the sort of simple view is, Qatar can't sell its gas at a reasonable price, so they've got a surplus, and so maybe some of the export capacity out of continental USA is going to get backed up or is backing up, which then affects Canadian prices, which move south for volumes moving south. Is that a potential scenario to Canadian prices or North American prices?
Yeah, you bet it is, Doug. It's the sort of counter argument to the positive, more bullish thesis that we're short supply with all the associated gas offline in North America. And so therefore, with the demand, looks like it's pretty robust still, even with COVID. Gas prices moving upwards because of this thesis that we're short supply. And then the counter argument, of course, is, but the world is long gas and there's a lot of cheap LNG on the water, and does that mean that LNG backs up into North America and helps sort of counter the short supply in North America? And so that's the bearish case for gas in North America, is return of the LNG that's supposed to be going out. Now, that being said, there was also some reports of Asian countries that have been switching over to more and more LNG to replace their coal. I think one of the things that they've experienced with all of the isolations and shutdown of the economies is that they've got cleaner skies over there and they've got cleaner air to breathe, and now all of a sudden the direct linkage between that dirty air they were breathing and the coal they're burning becomes more evident. And does that change public sentiment and government behavior in a way that they push harder to convert more coal to LNG and burn more gas, and now start to draw some of that excess gas that's on the water, if you will, over into those countries in a more significant way.
Good point. Maybe a silver lining there.
Yeah, for sure. In the very short term, of course, maybe that stuff doesn't happen that fast because you've got to convert coal to gas power generation, and how quickly can that happen? I mean, we saw in the U.S. that happened over a period of years, but in the short term, it's really probably more about the contracts and whether or not there is the takeaway contracts to ensure that that gas keeps flowing out of the Gulf of Mexico and out of those contracted LNG facilities. Is that over the next 6 months, for instance, is that enough to keep the pull on the LNG there and to prevent it from really backing up too much into the Gulf Coast and back into North America?
Just one more moving part. Last question. Yeah. So, other than condensate, are your natural gas prices or your natural gas liquids prices being negatively affected by the volatility in oil prices? I know there's some linkage there, but to what extent are they being affected? I know you're moving away. You're constantly doing this balancing act between lean gas and liquids-rich gas. So I presume there's some effect there other than just to the condensate portion of your liquids.
No, you're right. We sell our butane typically as a percentage of oil price. We try to link it to WTI so that way we can actually hedge the oil price and we get a direct butane hedge. That's the easiest way for us to do that. Butane, though, is typically used in the refineries to produce transportation fuels and the other products that the refineries use. So we sell it locally here to a lot of the refineries in Alberta. And if obviously demand for gasoline is way down and jet fuel is way down and the products that they produce are way down, then they're not going to be needing the same amount of feedstock. And so demand for butane could fall a little bit. Propane is somewhat the pricing and the demand supply situation for propane is somewhat driven by the U.S., although we are seeing a little more opportunity for Canadian propane to get exported to the Far East. AltaGas's project, for instance, off Ridley Island, gets us some volume out to that Far East pricing. I think generally just, overall global demand is soft because of the COVID, and so prices generally have fallen a little bit. But, we look at propane and butane storage levels in Western Canada. They're very low, and so we don't have a lot of that product in storage, which is good. In the U.S., propane stocks, for instance, are still, I think, at the high end of their normal storage levels, but they're falling quite quickly. And again, if you take a bunch of U.S. gas offline, then you're taking a bunch of the products that come from U.S. gas offline, so a lot less propane gets produced, and perhaps those storage levels for propane rebalance quite quickly. We'll see how demand comes back for propane. Arguably, the demand for plastic products seems to be up, so maybe a lot of the things that we make out of those natural gas liquids, demands for those products are going to continue to rise and be strong, and so therefore, we'll keep needing a lot of those NGL products.
The Pembina export project too, I believe, is on the near horizon here with respect respect to exporting propane off of the West Coast. So that'll add to Ridley, the AltaGas Ridley Island export. I think Pembina's boats will be going to South America with a bunch of that propane. So that'll add another pull from Western Canadian propane here come, I think 2021 is when that's going to start to happen.
Did Interpipe, they announce something on their PDH plant too, right?
Well, they're still proceeding, but you know,
it's lower and higher cost. Is that what they announced? Something like that.
Well, the cost is still. They're looking for another partner to try to help absorb some of that cost, but I can't remember the startup date. 2022. Yeah, and that's another 20-something thousand barrels of propane a day. So a lot of good, positive, constructive things on the near-term horizon with regard to the propane market in Western Canada.
Gentlemen, thank you. Carry on.
Yeah, you bet.
Thank you. Our next question comes from Aaron Bilkoski with TD Securities. Your line is now open.
Thanks. Morning, guys. I was just curious,
Sure.
You were one of the few companies to proactively build some internal condensate storage. As sands producers have announced shut-ins, have you guys actually seen volumes being shut in, and are you producing into those storage facilities? Just any color on that would be helpful.
Thanks, Aaron. We haven't yet. We haven't started to fill any of the condensate storage yet. We saw last month some apportionments on the pipelines that take our condensate away. We did manage to get all of our volumes put to market. And I think for the most part, we've been watching that very closely, and there still seems to be a good opportunity to get our volumes to market. Of course, prices are going to be perhaps another thing that gets determined, and we may have to live with some very weak prices. But as long as we can sort of get our condensate to market, then we can at least make that call on the price. We were more concerned, I think, with this condensate storage tank farm that we built, that we wouldn't actually be able to move our product at all, and that would be really disastrous because then we'd have to shut in all our production. So, you know, really this was somewhat insurance against the pipelines really getting full. You know, we've seen a fair amount of oil supply shut in, obviously on the heavy oil side. I think up to 1 million or so barrels a day is shut in now in Alberta. There is a knock-on impact for sure on condensate demand. What I've heard from at least one heavy oil producer, though, was that they were actually continuing to stockpile condensate a little bit because the price was attractive to them, and they had some tankage, and rather than fill up their tankage with their own production, they were using some of that tankage actually to store condensate. So in some ways, you know, that maybe that condensate market has been artificially propped up by the heavy oil producers who are continuing to buy even though they're not producing. But all this could still come to a head at any point, right? We've got a lot of volumes that are shut in. We've got a lot of storage that's being rapidly filled up. And so, you know, we needed to be prepared. We thought this was a pretty cheap bit of insurance that we could put in place for, you know, that would cover us for a short period of time while we reacted to what was going on.
Oh, perfect. Thanks for that.
You bet.
Thank you. As a reminder, to ask a question, you will need to press star one on your telephone. Our next question comes from Travis Wood with National Bank Financial. Your line is now open.
Yeah, good morning, guys. Darren, in your opening remarks, you mentioned kind of costs both on the capital and operating cost side. So I thought that you set that up to address that. So could you talk about the controllables that you have here in terms of where and how low capital could go through kind of Q2 to Q4, where you would be comfortable, how low that could possibly be, and then kind of where we could see savings on the operating cost side and perhaps even on the transportation cost side, as you were talking about some of the pipeline issues taking place at the moment.
Yeah, you bet. Maybe, Lee, I'll hit you up for just some color on capital cost savings, what we've seen in Q1, and maybe what we might see for the rest of the year.
Sure. I guess to start, you know, our species diversity, we've lost a little bit of ground because of, you know, redeploying our fleet efforts directed towards some deeper, gassier Spirit River species. So With that, we've started to heighten our frac intensity, and so we've lost a little bit of ground on our per well cost on that front. But we continue to see a lot of performance gains. Offsetting a lot of that is a lot higher pad efficiencies, and as we recalibrate on that with kind of new service cost portfolios, we're starting to realize that our pad efficiencies are perhaps much greater than what we've realized historically. So we've kind of got a recalibrated model on that, and our schedule coming up reflects a lot more pad operations in our schedule. On top of that, it's a pretty delicate balance right now with our financial health as we consider the financial health of our service contractor fleet, and we do recognize that a number of these guys are really just extensions of our company, and we need them to survive, and so we have a lot of really open, transparent conversations. And we work together. We've seen a lot of oil-based inputs like diesel fuel and drilling fluid base oil fall, in excess of 25%. So that's a pretty easy cost reduction to understand. Drilling rig day rates continue to reduce. Well testing, casing, those types of major inputs that comprise a lot of our capital cost structure have come down, in the high single digit to low double digit numbers. This industry is hyper competitive right now. The fact that there's only less than 25 rigs running, everybody's really thinning up where they can. There's been a lot of employment loss as a result, but everybody's really working together not only to find the bottom line margins that we can work within, but to really put their minds together and find ways to align with our staff and our engineers on improving efficiencies. And so, we look at this performance curve that we go through every quarter, every couple quarters, and every time we look at it, we sometimes get a little amazed that we still continue to see these performance gains despite drilling 1,000 of these things. And it's really a function of just everybody kind of putting their best heads together and finding ways to improve those timelines. So that's so in general, I think we're conservatively anticipating overall 10% reduction, and that's really surrounding what we're seeing in the near term on just service cost pricing reductions. So, with some continued efforts on performance improvement, hopefully that improves, and between that and pad efficiencies, hopefully we can offset the bulk majority, if not more than the cost increase we see from increased frac intensity and some deeper, longer laterals.
Okay, so that's the capital side, Travis. Todd, can you put some color on the op costs and initiatives to reduce those?
Yeah, for sure. Like Lee mentioned, we've been talking with service providers, and they've been, willing to reduce costs in some areas. So we're going to see that through the year. Basically since 2018, we've been negotiating road use costs with road owners, and we've seen some pretty good gains on that. We at the end of last year, we had 2 significant reductions to a large number of our wells with 2 road owners. Now, due to the lag in billing, we won't really see those cost benefits until Q2, but they will continue in perpetuity. So we'll continue to work on that throughout this year. We're talking to a couple other road owners as well, so hopefully we can get them to move a little bit on their rates. As I mentioned, lubricating oils, we expect those to fall. And again, with methanol, we expect that to fall. We've already seen about a 16% drop in the methanol price from Q1 into Q2 here. So we expect to see that fall throughout the year. And then we usually renegotiate a contract that somewhat floats on the Canadian dollar, but we renegotiate that usually in the summertime at the low price point. So we get a benefit from that. And then as well, here early in Q3, we plan to commission our water disposal well and facility. So that should help us to see a bit of a modest reduction in our water handling costs for the rest of the year and going forward. And then I guess a bigger point, finally we're starting to see some reduction in government fixed costs. The AER admin fee has been reduced for 2020. We have indications that property taxes will be reduced. We don't know exactly what that number will be yet. We're hoping that it's significant. I know CAP has been asking and working with the government for quite some time, about a year and a half here. So hopefully we'll see something meaningful come from that, and something beyond 2020. I think with the AER, I think they've agreed that their budget will be reduced going forward, so that will be something that's not just 2020.
Okay, good. Trav, does that answer most of that?
Yeah, that's great. Thank you.
Thank you. Our next question comes from Derek Wenger with a private investor. Your line is now open.
Yes, 2 questions. I came in late. I apologize. 1, when will the balance sheet be published? And 2, was there any change to the dividend?
No change to the dividend this quarter. Obviously, we announced prior to coming into the quarter that we were reducing the dividend significantly. That was really on the heels of a lot of the OPEC plus activity, and then the further impact of COVID-19 on demand. When we finally started to see the evolution of the commodity price tape after all that change in Q1, we announced that we were taking the dividend down to 1 penny a quarter. We're cutting our capital back by $50 million, midpoint of guidance. So we had made those adjustments really coming into the quarter. With respect to balance sheet, are you talking about the banks and our bank liquidity and that kind of thing, or?
No, I'm just talking about the balance sheet in general. I didn't see it on the press release, and I don't see it on CDR.
It's not CDR filed. It is on our website. If you go into the press release and click on the link at the end of the press release, it will take you directly to the financial statements and to the MD&A. Alternatively, you can go directly to our website, www.peyto.com, and you can get to the financial reports. Under financial updates, there's a link on the front page that will take you right to the financial statements.
Okay, thank you. I'm sorry.
Yeah.